Hello and welcome back to our second demo slash lecture video dealing with Chapter 5, Cost, Volume, Profit Relationships. In this video, we're going to look at exercise 5-18, which goes along with your study guide. And in this video, we're going to talk a little bit more about break even. Going to probably talk a little bit as well about the contribution margin. But we're going to get into more detail looking at the margin of safety, and we'll talk a little bit about the operating leverage as well. I believe in this problem. So I'm on page 231, and again, this is exercise 5-18 in your textbook. So, and bear with me here, I'm going to go ahead and just kind of start there. Just kind of put some of the information that they give us out of the problem. So they give us our sales figure, and they tell us it's $450,000, and they give us our unit price of 30 bucks. They give us the variable cost as well, and they say that the total variable cost is $180,000 in this example, and they also give us the variable cost per unit, 12 bucks. They calculate the contribution margin for us. Bear with me here. Sorry guys, I'm a little anal when it comes to Excel. I want to make sure it looks all nice and neat. So they calculate the contribution margin for us, which again is nothing more than sales less variable cost, right? We said in our previous video that the contribution margin is what is left over after variable costs have been deducted from our sales. Then they give us the contribution margin, per unit, which again is just sales less variable costs on a per unit basis. And we see that that's $18. They give us the fixed costs, which they tell us are $216,000. And they give us our net income in this example, or net operating income of contribution margin of $270,000 minus the fixed costs, $216,000 of $54,000. Okay, and again, bear with me. Perfect. Okay, so number one wants to know what is the monthly break-even point in sales and in dollars, right? Well, we said in the last video that the equation form, and we have the formula form, right? Or the formula method and the equation method. Well, the formula is pretty simple, right? It's just nothing more than fixed costs divided by our unit CM if we're looking for break even in units. And we said that if we're looking for it in dollars, it's our fixed costs divided by our CM ratio. Okay, very simple. So before we jump into this, do we have enough information? DE in dollars. Okay. Well, sort of, right? We got our unit contribution margin, we got our fixed costs. The only thing we don't have is our our contribution margin ratio, which is very simple, okay? We could do this either on a total basis or a per unit basis. It doesn't matter. We're going to take our $18 and we're going to divide that by our sales price of 30. So our contribution margin should be 60%, right? But I didn't need to do that, right? I didn't need this equation. Don't need that. Because once I get the break-even point in units, I just multiply the sales price. That gives me what my um, break-even in dollars is, right? So let's go ahead and work it out. We have our fixed cost of $216 divided by our contribution margin ratio of $18. Our break-even in units, hopefully, is 12,000 units. Yep, looks good to me. Perfect. Now, in order to get our sales, break even in sales, very easy to do, right? We don't need this equation. To figure out what it is in dollars, all we do is say, okay, 30 bucks per unit times 12,000 units, we get $360,000. Easy peasy, right? So the second part says, without resorting to computation, what is the total contribution margin at the break-even point? Okay? So this is easy for us to do. This is so easy. The reason why it's easy is because we know the definition of the contribution margin. We know that the contribution margin is what is left after deducting variable expenses from sales, and it's the amount that goes to cover our fixed costs and hopefully provide for a net operating profit. Okay? We know at the break-even point, our contribution margin has to equal our fixed costs. So what's the contribution margin? It's the amount of fixed costs. It's $216,000. So on your study guide, you should put $216,000 as your answer, and you should explain why it's $216,000. And again, it's $216,000 because the contribution margin is equal to the fixed expenses at the break-even point. Okay. Number 3 says, how many units would have been sold each month to attain a target profit of $90,000? Verify your answer by preparing a contribution margin format income statement at the target sales level. Super duper easy, right? Super easy. We know how to do this. Not a problem. We solved this in our last problem, right? So for number 3, the first thing we got to do is figure out, okay, what's our target profit in units? Well, what target profit do we want? Well, we want a target profit of $90,000. Okay. We know, and bear with me here for 1 second. Notice what I'm doing. I'm just copying the break-even equation, right? I'm just copying it because we're looking for target profit. And all I need to do is add the target profit to the fixed costs. Okay? So what are our fixed costs? Well, they're $216,000 plus the target profit of $90,000 gives us a total amount of $306,000. Okay. We're going to divide by our contribution margin. What's our unit contribution margin? What's this $18? We then divide the two, and we end up with 17,000 units. Okay? 17,000 units. All right. The next thing they want us to do is to prepare that contribution formatted income statement. we already know what the structure of it is, right? Sales less variable cost equals the contribution margin minus fixed costs gives us net operating income. Okay, so what they're telling us is, oh hey, by the way, we want you to prove that that little calculation of 17,000 not units really gives us a net profit of $90,000. Well, okay. Well, it's always a good idea to put per unit and, or I'm sorry, put the per unit selling price, variable cost, and contribution margin right next to the totals. Okay, so that's what I'm going to do. I know my selling price per unit's $30, variable cost and contribution margin have not changed, right? Notice in this problem, they didn't say, hey, you had a change in structure. No, the per unit prices stay the same. The only thing that changed was our volume. So I'm going to take my 17,000 units and I'm going to multiply it by my $30 selling price. Next, I'm going to take my 17,000 units and I'm going to multiply it by my variable cost per unit of $12. I get 204,000 bucks. Now, to figure out the contribution margin, I could do one of two things. I could subtract sales minus variable cost, 306. I could do it that way. But we know how this contribution margin works, right? We know it's a very important concept. If I multiply my unit contribution margin times my unit sales of 17,000, I get the same number, 306, okay? The fixed cost did not change. They're still $216,000. So what then is my net operating income? Well, contribution margin minus variable cost, 90 grand. So yes, that calculation, the units sold to attain a target profit of $90,000 or 17,000 units need to be sold to attain a target profit of $90,000 is accurate. That's what we calculated in the problem. We just kind of proved it visually. Okay. Now the next thing we need to look at is margin of safety. Okay. So we haven't really talked about margin of safety yet. So what exactly is our margin of safety? Well, hopefully you already know because I'm sure you've already talked about, or you already read the chapter and worked through the study guide. But when we're looking at the margin of safety, really what we're looking at here is the excess of actual sales or budget sales over the break even in sales dollars, okay? Margin of safety is a pretty important number for us to know. Why? Because this is the amount of which sales can drop before we actually incur a loss, right? Our sales can drop by a certain number before we end up losing money, meaning our sales are not enough to cover our costs. Excuse me. So sorry. Okay, so let's look at the margin of safety. We know what it is, and this is actually part 4 of the problem. So what is the margin of safety? Well, we know we're able to define it, but how do we calculate it? Well, it's easy. It's total sales minus the break-even point. Okay? Now, without even doing any calculations, because numbers did not change, right? Meaning, or we're going on, I'm sorry, I apologize. We're going off number 3 numbers, right? We're using that target profit of $90,000, okay? Yeah, we're using that target profit of $90,000, right? So Actually, no. Further the original data, compute the company's margin of safety in both dollars and percentage terms. Okay, so if we're going by the original problem, guess what? We need to figure out what is our contribution margin in dollars. Well, it's 360,000, right? We already figured that out, so we're using the original data. I apologize. We are not using the data in number 3. Okay, so we're using the original data of 12,000 units sold, $450,000 of sales. The break-even point in sales dollars that we got for number 1 is at $360,000. Okay, so what we're going to do is we're going to take our total sales of $450,000, and we're going to subtract that from the $360,000. So that ends up being $90,000. Okay, so that's the break even in dollars. Or I'm sorry, that's the margin of safety in dollars. Sales can drop $90,000 before we're in danger of incurring a loss. Okay, how do we figure this out in a percentage form? It's very easy. To figure out the MOS percentage, or the margin of safety percentage, we take the margin of safety in dollars, and we divide that by total sales. Okay, very easy. So what is our margin of safety in dollars? Well, it's 90,000. What are the sales, the total sales volume? Well, again, that's the 450,000. Okay, so to figure out that answer, we just divide 90,000 by $450,000. We end up with 20%. So another way to state the margin of safety is in percentage form. We could say that, hey, our sales can drop by 20% before we're in danger of incurring a loss. Okay? Now let's look at number 5. Number 5 says, what is the company's CM ratio? If sales increase by 50,000 per month and there is no change in fixed expenses, by how much would you expect monthly net income or monthly net operating income to increase? Okay, so pretty easy for us to do, right? What's the first thing we need to do? Well, the first thing, the way we figure this out, this will be number 5. The way we figure this out is to first figure out what is the CM ratio, right? Well, we already said it's 60%. We already did that, okay? So why they're saying, what is the company's CM ratio? Yeah, we already did that, okay? Yeah, we already did that, okay? So we're good there. I'm sorry, I got ahead of us, okay? So now what we do is we basically do a little bit of differential analysis, okay? So let's look at it this way. They tell us that, hey, sales increased by 50,000, okay? So what's the expected contribution margin? Expected CM with increase. Well, that's easy to do, right? Sales go up by $50,000. Well, they're already at 400,000 or 450,000. They go up 50,000, so that means they go up to $500,000 times our 0.6, or our contribution margin. So that's $300,000. Okay. That's 300 grand. That's the expected contribution margin with the increase in sales. Okay. Step 2, we need to figure out what's the current CM. What's the current contribution margin? Well, that's easy for us to do, right? We could just plug and chug the number that we took here. Oh, the contribution margin is $270,000, right? We could do that. That's acceptable. Or we could calculate it. How do we calculate it? Well, $450,000 times 0.6, or 60%. We get $270,000. Okay, so in order for us to calculate what the increase is, we could say, okay, well, the difference in the contribution margin is $30,000. Okay, that's one way we can do it. There's a quicker and dirty method, and I'm hoping that you watched the first video, you understood it, and you're like, wait a minute. Is that when I started doing this method, hopefully you jumped up and said, wait a minute. I know that once we're past the break-even point, which obviously we are because our net operating income's $54,000, all I need to do is multiply the increase in the sales, excuse me, by the contribution margin. That is true. So an alternative way we can do it is we could take just the increase of $50,000, just the increase of $50,000 times the contribution margin ratio of 60%. We'll turn that into a percent. There we go. So what then is our increase in net operating income? $30,000. So the point here was it's the same calculation. We're just taking the change in the contribution margin between an increase in expected sales and the current CM. That gives us our increase in the current contribution margin. Or we could do it the quick and dirty method by looking at that differential analysis and saying, okay, well, sales go up by 50,000. I'm going to multiply that by the CM ratio. Boom. I get $30,000. Now, why did I use the ratio and not the unit contribution margin? Well, the reason why is because remember how we calculate the break-even point. When I said, hey, when we calculate break-even in units, we got to use the unit CM. When we were dealing with dollars and kept trying to figure out the dollars and break-even point, we got to use the CM ratio. They gave me an increase in sales, right? In the previous example, I used units, so that's why I multiplied by the unit CM, okay? In this example, they gave me dollars, so I couldn't multiply $50,000 by $18 per unit. That wouldn't give me the right number, right? One's in units, one's in dollars. So if I'm trying to figure out what my answer is in dollars, I always got to use that CM ratio. So that's why I multiplied that increase in sales dollars by that CM ratio, okay? So given that the company's fixed expenses are not going to change, that's what the problem told us, right? Nothing else changes. We just increase our sales. Because the fixed expenses will not change, the monthly net operating income is going to increase by the same $30,000 that the unit contribution margin went up. Okay, that's pretty much it for that problem. Operating leverage. I apologize. I thought it was in this problem. It was not. Basically, all it is it tells us, hey, how sensitive is our bottom line, meaning our net operating income? How sensitive is that to a percentage change in sales dollars? Okay, So basically, what we do is we figure out what our degree of operating leverage is, and we multiply that by a percentage change that they give us, right? Hey, our percentage change is 10%. Okay. Well, if we have 5 as a degree of operating leverage, we multiply those out, and that'll tell us pretty much um, how sensitive that net operating income will change. It'll go up or it'll go down. Okay. So, not too difficult, really, a concept. I think you're okay now. If you would like me to do some more demo problems, um, let me know. I'd be more than happy to actually go over um, the at the end of the book. They give us the fundamental 15, I think, or the foundation 15 problem, and it covers all the topics. So I tell you what, actually, I will do that. Um, I will put that up for you probably Thursday or Friday night if that's okay, so you'll have it for the weekend. Again, you have any problems, please feel free and text me. It's totally not a problem. Remember, we have an exam this week. The exam's due on February, off the top of my head, I can't remember. I know it's 2 weeks. It's due on the 18th of February, the exam, and Chapter 5 homework is also due on President's Day, the 18th. Okay? So keep that in mind. Reach out to me if you have any issues. Just shoot me a text, and I'll get back to you. Or call me, and I'll call you back. So thanks for tuning in, and we'll talk to you soon.